Welcome to another Contrarian Gold Mine episode. Today we'll look into another company close to their 52-week low. I will warn you, this is not a high-flying company where YouTubers are pumping the stock and making investors losing money. This is a slow grower, a mature company with really good fundamentals and possibly at a good valuation, because at the moment they are having some troubles, but they are settling it, and it's problems that are really solvable easily. So, with no further ado, this is 3M. 3M is basically an industrial company. Everyone knows it. You probably, if you look into around you, you'll find a 3M product, even though you don't even know what is the brand of that product. It's also that is 3M that's producing it. It's a conglomerate. They produce components, goods for the industry, transportation, healthcare, consumer, office, security, electrical and communication products, communication, a lot of products. This is a really huge company. They used to trade at a high around $250, and now they are trading under $100. I've been looking into it more now because they are trading lower. They just hit a 52-week low of $85 on 23rd of October. Now they recovered already around 10%, but they are still a company that looks into a good valuation. No, we will analyze that now. So basically, 3M, they have a market cap of $51 billion. They are, even though they are not making profit this year, that's why this fundamentals is a little bit shaky, because they are having a lot of problems. They have a lot of lawsuits that in the last month they are settling it. They are resolved. That's why the stock is probably recover in the next few months. But they just settle. They will pay a fine, and it will be taking into the future profit, because they will pay that in the next 10 years. But in the last income statement, they just read it like it was they paid all of that 10 billions. I don't know, it was around that. So that's why you have like $7 billion of a loss this year. That's why you don't have a lot of fundamental. You will not have a PE for this year. But what can I say? This is a company with really high quality. If you look into the return on invested capital, it's negative. Return on equity, it's negative. But that's because their net income this year will be negative because of the fines they will pay. So you have to look into the past. So it's a company that is not growing fast. If you look into expectation, last year the revenue decreased 3%. They are expecting this year to only report $31.6 billion of revenue, which is 7.5% down from last year. But that is still a wide moat company in my opinion, because they manufacture a lot of goods that you probably will see around you every time, every day. And in the next year they have an advantage, a competitive advantage, because they already have the production lines for that product, and it is a business that they have high barriers to enter, because they have a lot of factories. They already have the process of the products, and it's really difficult to compete with 3M. And if you want any good with high quality, you always want to buy 3M and not any Chinese product. For example, I work in industry, and I know 3M has the best products in the market. So, for example, but looking into it, this is a slow growth. Their revenue are only grow under 2%, but that's because the last years have been really bad. But I'm expecting them to recover sometime in the next few years. They will grow with inflation, but we are not expecting to grow double digits or even high single digit. In my opinion, it will be around inflation. It is a slow grower, but it might be at we have a valuation for that, so you can earn money in even in a company that is not growing, or even in a company that their revenues are decreasing. It all have to be, you have to buy the company at the right price. So that's what we'll look into it. So look into their fundamentals. The company is expecting trading at forward P under 10, which is a earnings yield above 10%, which is really good. If you are an investor, having 10% each year, it is really good, and it's profits that we'll have in this year, so that is really good. Balance sheet is it's not bulletproof, there are some fines, but I do really think that is manageable. They have $5 billion in cash, and they have a long-term debt of $13 billion, but they can pay that easily. They have a free cash flow around $4 billion a year. Their net income, if you look into trough year, which was the 2021 year, they earn a net income of almost $6 billion, and the valuation right now it's around $50 billion, which it makes, if you look into the trough earnings, it is earnings yield above 10%. It will be around 12%, which is really good for a company of this quality, special. And it is only happening because the company is having some trouble. But in my opinion, it is solvable, and this is an opportunity maybe to buy a high quality company with a lot of competitive advantage and a wide moat that is not going anywhere, in my opinion. So it might be a really good investment. It's an investment that you have to be patient. It's not a turnaround because they are selling products. Still, they are making profit. Just a little bit of problem. But the return on invested capital now it's negative because of net income is negative for this year. But if you look into the 5-year return on invested capital, the average it's around 15%, which is really high for an industrial company, for example. So this is a diversified company with a really high quality, in my opinion. So, but you have to buy it at the right price. But what is the right price? So I will share my discounted cash flow. This is my assumptions. My base case, my discount rate will be 11%. Bear in mind, this is not the intrinsic value, because that intrinsic value will be around 10%. But I'm doing a little bit of premium on the P18, but I do really believe they deserve it because of their return on invested capital in the last 5 years, for example. Their margins, I'm expecting them to maintain around 16-70% on my base case, and I'm expecting them to grow at 7% and 5% for the last 5 years. And this might be a little bit high, but I have this because they have to recover. Their revenues are going down, and in the future I'm really hoping that they will recover. At this base case, bull case and bear case, I come with an intrinsic value. That is the price that is not the intrinsic value, but it is my fair value, the value I want to buy this company. It is around $100. I full disclosure, I do own this company. It is a company I have in my portfolio and I really like, and I hope this stock goes down so I can buy more shares cheaply and have a higher return in the future. But at the moment I have a small position still. I'm still looking to a better opportunity to increase my position. I've started to buy this company around $105. I've increased my position when it hit $95, and I even increased it when it bottomed out around $87. So I'm increasing my position, but it is still not a full position of mine. So I'm really happy holding because it have a really high dividend. I don't know if it is safe, but even if they cut the dividend, I'm really happy. I do believe they should buy back a lot of shares, and they usually do buy back a lot of shares. And in this stock we can have a PE expansion because they are trading at a really low PE. If you look into the average of the last years, it is a stock that can trade at a PE of 20, for example, and we have a double just for PE expansion. They will do a lot of not a lot because they have a high dividend, but they can do some buybacks at this valuation, which will be accretive to the shareholders, and I hope they do. The dividend, I don't care, but it is a really healthy dividend, but I would prefer that they buy back shares because it is a better option in my opinion. So they can do share buybacks and pay a dividend. They can we can have a PE expansion, and then they can resume growth. They have, even though it is a slow growth, it will be a growth in the next year, because I do not believe 3M will go anywhere else, or it will go bankrupt, or it will disappear, or they will have a lot of competition that will take them off the market. I don't believe that will happen at this valuation. This might be a really good opportunity, guys. I hope you find this video useful, and I hope you liked it. And if you liked it, please subscribe, guys. Bye.